welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Now, the most festive part of the year is upon us, and that's why we are here with our special series. Last week, we told you how to shop smart, and now it's time to talk investments. So this week, we turn the spotlight on real estate. Will property actually turn out to be a worthwhile investment in the coming year, or are you actually better off without it? And if you are indeed looking at realty investment, then what are the basic hygiene personal finance themes and rules that you need to keep in mind? Joining me to answer all of those questions today is GULAM of Knight Frank, as well as personal finance expert Karthik Zaveri. Gentlemen, great to have you in the studios. Thank you so much for taking out the time and being here with us. Karthik, I'm going to start with you because we've had several conversations on this in the past, and you've always said that if you want to buy property, the earlier you do it, the better. Elaborate on that principle.
See, it's very simple. When you're starting off your career, you have a long way ahead. You know that you will have a lot of responsibilities that will be cast upon you over a period of time. For the time being, you're enjoying yourself, you're enjoying your salary or your business income or whatever the case might be. Therefore, because there is not so much of commitment on your cash flow, you can afford to deploy as much as maybe 40 or 50% of your cash flow just to pay an EMI. And what happens is, it's a great starting point. It's a great confidence builder. You already have an asset. When you've bought an asset, maybe an under construction one, in 4 or 5 years' time, you'll see an appreciation happening. You've bought the property at the end of the 4 or 5 years. You may choose to live in it. That's an option. You may choose to not live in it. Either ways, you have an asset. You've got a backup. To do this thing at your age of 30 and 40, when you have too much of commitment on your cash flow, becomes that much harder.
So, GULAM, buying property is the great Indian dream. It always has been. Is this a good time?
Well, I don't believe this is the right time to buy because, first of all, last couple of years, the property prices have just gone up and are currently absolutely unrealistic. While at least one market, that of NCR, is showing some cracks, it's actually correcting itself by about 15-20% in last quarter or so. We have seen it coming down. But the rest of the India still has to come to realities. To me, it's extremely exaggerated. So if you're entering into property market at such a high price, for you to make money, I never would believe so. So at least the time now is not right. I would rather wait. As an investor, I would wait for the property prices to come down. If I'm an end user, I would buy any time. As I said, I would still buy it if I have to use it for myself. But if I'm just a mere investor, I would definitely keep away from it.
Okay, so elaborate on that point. When we're thinking of, investments, asset classes in terms of gold and, equity, bonds, what do you want, real estate? According to you, since you're the market expert, should it be part of the basket right now or not?
Look, to me, it's simple. If you're looking at your portfolio, anything which is giving you, less than 10-12% of annualized return should not be touched upon it because there are better options to invest than this particular asset class. And to me, if your property prices are not doubling up in 5 years, you should keep away from that property. So if you have at least that much of understanding to pick out the right property which has to double up in 5 years, you should buy, else keep out. Because at 5, about 12 to 13% kind of return that you will make annually, and then talk about inflations and this and that and so on. If it doesn't make so much of money, keep out of it. Okay. And mind you, in the country, I can't find such opportunities where anybody convincingly will say that in 5 years it will double up. I can't find even one such location where I would say that, hey, pick up this location, anything that you buy here will double up in 5 years. There's nothing so much.
Well, when a realty market expert tells you not to buy, you've got to actually sit up and take notice. But Karthik, your thoughts on the rules of investing? If you are going to invest in property, then some of the return ratios that GULAM was just alluding to.
Oh, I would absolutely agree with that. I mean, we are expecting a return of somewhere in the range of 12 to 15%. So if the case does not stand up for that, obviously you don't do it. However, you take a step back, which we normally say.
But 12 to 15% over what time frame? Because, there are those who will always argue that it's a nascent market right now. I mean, I'm trying to invest ahead of the curve.
Sure.
So I won't get those returns now, but maybe 5 years down the line. So then how do you do the math?
So the logic is this. You expect that the capital appreciation on your property would be somewhere in the range of 7 to 10%, and you have a rental yield of somewhere in the range of 2 to 4%. So you add up these two things together and you come up with a conclusion that you should be able to make at the bare minimum about 10% on a property, and in a very good scenario maybe about 16-17%. So the average falls somewhere in the range of 12 to 15%. So that's the rule of thumb. But still, you would do all of that once your basic financial goals are in order. So once you finish investing for every everything that you need, then when you have your surplus monies, then that's the time we think about an investment into a real estate, but not before that.
Okay, all right. So we've got the basic thumb rules in place, the kind of returns that you must make if you're going to invest in property. We'll come back and talk about whether those opportunities actually exist in the country anywhere in any of the markets. Back in a moment.